Fiscal and monetary policy artificially affects the economy. In this episode, I'm going to address the question, what does the government do to stimulate the economy or attempt to stimulate the economy? Get ready, I'm going to share some insights that maybe you didn't even realize before. So my name's Doug Andrew, and I've been a financial strategist and actually a retirement planning specialist now for more than 47 years. So I've watched a lot of things that Congress does, government, in order to try to speed up or slow down the economy. And sometimes people don't understand how the government sort of artificially tries to stimulate the economy or slow down the economy if they think it's going too fast. So in this episode, I'm going to enlighten you with some understanding about the money supply, interest rates, taxes, and how they all affect how the economy is going. I'll explain what the velocity of money is so that you can begin to understand a little bit about when you hear, oh, they passed this stimulus package. What that really means and how it indirectly is trying to stimulate the economy. So generally speaking, when we experience a sluggish economy and money isn't moving, the government likes to speed it up. So in order to speed up the flow of money that people are using to build homes or to live, go out to eat and so forth, the government can speed up the flow of money by lowering interest rates. This is one of the first mechanisms or strategies that they'll usually use with the Federal Reserve. And so oftentimes the feds will declare what the rate is, and you hear, well, the Fed's going to raise rates or lower rates, and that means that they're going to be trying to affect the economy, speed it up or slow it down based upon the supply of money. And if you have low interest rates, that means more people are borrowing money. It stimulates construction of new homes or refinancing of homes because people go, wow, my current mortgage is at 4 or 5%. And now mortgages are down in the 3s or the 2s, I better seize the opportunity to refinance my house. Well, when people do that, generally they go, well, my house has gone up in value. And most people go, well, listen, I can refinance and take cash out because I have equity. The house is now worth more, and I can refinance up to 75 or 80% loan to value, which is usually called a cash out refi, cash out refinance. And they go, golly, my payment won't be any higher even though my mortgage is higher, and we can take $30,000 or $40,000 and finish the basement or finish this bathroom or whatever. And that creates jobs, opportunity for contractors. So when you lower interest rates, that makes the money supply easier. People can borrow money, and then they use that borrowed money to improve their homes, to buy land, to invest, to expand their businesses, and so forth. Does that make sense? Now, another artificial way that the government tries to stimulate the economy is by spending, the government spending. So as the recording of this episode, we have been coming out of the COVID-19 pandemic, and because of that, the government passed several stimulus packages to try to keep money flowing when everything just sort of came to a standstill. And oftentimes the government then will spend money and create projects, and they will try to put money out into the economy and give people stimulus packages or extend unemployment benefits and so forth. And this is designed to have people have the wherewithal or the flow of money to continue to go out to eat and to buy the goods and services that we normally buy during normal times. So what happens is when the economy starts to slow down and unemployment happens and businesses are not selling as many goods and services, they have to lay off people, and this causes prices to go up, unemployment to go up. So the government tries to offset that. oftentimes by creating jobs, by saying we're going to hire another 10,000 IRS auditors or what have you, and we're going to find money. We're going to justify paying them because they're going to find money that people should have been paying in taxes that they're not and what have you. But they're trying to get people to work, and when more people are working, they spend more to indirectly stimulate the economy. But sometimes, if you haven't noticed, the government overspends. What? Now, they get away with doing stuff that we could never get away with. For example, as of the recording of this episode, the government in the last year and a half, primarily because of the COVID-19 pandemic, has passed legislation and has new legislation on the table, infrastructure packages, stimulus relief packages, and so forth, where they are spending 3 to 4 times what they bring in revenue, okay? The IRS collects around 3.5 to 4 trillion a year in taxes. That's their income. And they have been spending anywhere from double and then up to triple that. And it looks like it may even go to quadruple that. What does that mean? If you were making 100,000 a year and you were constantly spending 300,000 or 400,000 a year, how long could you do that before what? You would have to file bankruptcy. So we get into trouble, and so the government then tries to adjust interest rates and manipulate what inflation will do, because inflation is like a hidden tax, and it goes up, and what happens? It backfires. So let me share with you what you can do to protect yourself. So before I go any further, if this is intriguing you, the reason why I post these educational videos on this channel, Three Dimensional Wealth, and if you can think of somebody who ought to be hearing or watching this episode, be sure and share, post a comment, click like, subscribe to the channel. I post at least 5 new educational episodes every single week. And my purpose and passion is to enlighten you. I'm 69 years old and I've been helping people optimize their assets and minimize taxes for years. And at the end of this episode, I'm going to show you how you can claim a free copy of my most recent best-selling book, book number 11. It's actually 2 books in one. And this will help you understand what you can do to protect yourself from the negative impact of government trying to stimulate the economy, and then they end up raising taxes, they cause inflation, and they create market volatility. So let's connect the dots and help you understand what happens when government spends. It's sort of like when somebody drinks an energy drink, whether it's a Red Bull or some kind of an energy drink or a 5-hour, and you get this temporary high from the caffeine in that. And then what happens? Then you have a crash afterwards, and sometimes you feel worse after that temporary high. And that's what happens oftentimes when the government is artificially trying to stimulate the economy. It lasts for a year or 2, but it's artificial, and then we end up with like a crash worse than if we would have just been laissez-faire, which is a French term that means just leave the economy alone. Let it just go. Well, when the government is so interested in looking good to get reelected officials, politicians, so many politicians, they don't understand economics, but they try to make it look like the economy is booming, vibrant, dynamic artificially so that they can get reelected or what have you. So there's ulterior motives for what many times they do. The point is this: the velocity of money is where money flows or churns in America. In other words, there's far many more trillions of dollars that are sort of flowing through the economy than even exist in print. So let me give you an example. If I were to go to a bank and borrow, $500,000 or $1 million to build a new home, okay? Now, the bank loans me the money, and they loan that to me at 4 or 5% interest. So 5% is $50,000. Now, what happens? I take the $1 million, the loan, the construction loan that turns into a long-term mortgage. What do I do with the money? I pay the general contractor, the subcontractors, and they all take that money, and what do they do with it? They put it back in the bank, the suppliers, the lumber companies, and so they deposit their profits back into the banks. The banks get the money back, and the banks only pay them 1%, and yet they're charging me 5%. How much more is 5 than 1? Don't say 4, it's 500% more, it's 5 times. Would you hire an employee for $10,000? 1% on $1 million is $10,000 a year. That's all the banks pay for your money. and they turn around and charge you $50,000. So would you hire an employee for $10,000 that made you an extra $50,000? Would you buy a widget machine for $10,000 that made you an extra $50,000? That's called a 500% return on employment cost. But the bank does it sometimes 16, 17 times a year on the same money. They loan it out at 5, get it back and pay 1. They loan it back out at 5 and get it back at 1, 17 times a year during a vibrant economy because the money's flowing. During a recession, that churning of the money only maybe happens 10, 11, or 12 times a year. So there are more taxes that people have to pay. There's more employment and jobs when the money flow, the velocity of money is flowing, and they try to stimulate that by lowering interest rates. And if it starts growing too fast, then they raise interest rates. And they manipulate it with fiscal and monetary policy, and then they raise taxes, they lower taxes, they print more money, then they try to cover that up, and people get raises, and then the raises are gobbled up at the gas pump. And when they go to McDonald's to get a hamburger, because now employers are forced to charge more for their goods and services because of inflation, and that causes the purchasing power of the dollar to go down. So sometimes it just gets all messed up, and it's because of what? Government trying to meddle or interfere instead of just leaving the economy alone, laissez-faire, just let it be. So the point is, when government tries to stimulate the economy, they print money to cover their deficit, their overspending, or they raise taxes, and they think that is not affecting the economy. They say, well, we'll just tax the rich. Well, one of the biggest hidden taxes is inflation. That affects everybody, but it hurts the little guy. And the problem is, many politicians say, oh, I'm out to protect the little guy, but they hurt the little guy because they're spending too much money as a government, and so then they have to print money. That causes inflation, and now the little guy, I don't care if you raise them to $20 or $30 an hour, they go to the gas pump and gas costs twice as much as it did a year ago, meat and all kinds of goods and services, and so what good did it do? So that's why I say it's counterproductive oftentimes when the government tries to stimulate the economy with this artificial temporary like sugar high or caffeine high, and then it wears off. So where can you learn more about how to handle your money so that you're immune from this? I mentioned earlier, I'd like to gift you my most recent best-selling book. It's called The Laser Fund. Laser is an acronym that stands for Liquid Assets, Safely Earning Returns. And this book is about how to diversify and create the foundation for a tax-free retirement so you're immune from taxes. You'll learn how this will outpace inflation, okay? Because you link your returns to the things that inflate, and you're immune from market volatility. You make money when the market goes up, but you do not lose when it goes down because your money's not at risk in the market. Sound too good to be true? Well, read this. This is actually 2 books in one. This side is 14 chapters, about 200 pages with all the charts and graphs. If you're more of a right brain learner, you flip it over to this side, and this is about 100 pages, 12 chapters with 62 like chicken soup for the financial soul stories. If you want to use your whole brain, right brain and left brain, read both, okay? Just simply go to laserfund.com, click below, contribute a nominal amount towards the shipping and handling. I'll fire out a copy to you. There's also options there to listen and learn, watch and learn, and we teach educational webinars all the time. So here is to your brighter future.